Welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And our mission is to become the Google map for hardworking Canadians seeking financial freedom. Today's topic is how to pay off your primary residence mortgage 14 years earlier. If you're a homeowner with a mortgage, you probably already know the era of ultra-low fixed mortgage rate is over. As a matter of fact, over the last weekend, I was speaking to my sister-in-law. She's about to renew her mortgage, and she committed to this ultra-low fixed rate mortgage 5 years ago at 2.19%. And so as many Canadians, they locked in cheap fixed rates as low as that 2.19% in my sister-in-law's situation over the past 5 years. And now it's time to renew the mortgage. But those fixed rate terms are expiring, and homeowners renewing now are looking at much higher mortgage rates. Well, at the same time, the Bank of Canada last week just cut its prime interest rates, and more cuts are expected to come this year, thanks to Trump's crazy tariff policy. That means HELOC rates, the home equity line of credit rates, are coming down because home equity line of credit are tied to variable rates majority of the time. Now, making it a great time to revisit this strategy called Smith maneuver as a tax-efficient strategy to build wealth while paying off your home many, many years faster. But is it the right move for you? Let's break it down in simple terms. But before I get started, if you like our video, please hit the like and subscribe button. And if you have any questions, make sure you leave in the comment section below, and I'll try my best to answer your comments and questions. Now, with that, let's get started. What is this thing called Smith maneuver anyway? Most Canadians don't realize this, but when you take out a mortgage on your primary residence, the interest that you pay is not tax deductible, unlike in the States. That means you are using after-tax income to cover one of your biggest expenses. However, borrowed money used for investment purposes can have tax deductible interest. So if you borrow money to invest in a GIC, you can borrow against your home equity line of credit, incur interest expense on it, but the interest expense, CRA would allow you to write off the interest expense. Now, the Smith maneuver is a strategy that converts your non-deductible mortgage interest, your non-deductible primary residence mortgage interest, into something that's tax-deductible investment loan interest. Now, here is how it works. Number one, you need a readvanceable mortgage. This is a mortgage combined with a home equity line of credit. As you pay down your mortgage principal, the mortgage part, your available credit in your home equity line of credit would automatically increase, and allowing you to continuously borrow against your home equity without reapplying for a new loan. Step number two, as you make mortgage payment, your available HELOC credit increases. Step number three, you borrow from your HELOC and invest the funds in income-generating assets, such as rental properties, dividend-generating stock, interest income, etc. Now, number four, since you're borrowing to invest, the HELOC interest becomes tax-deductible. Step 5, you use your tax refund and investment income to pay down the mortgage faster. Tax refunds from the HELOC interest deduction can be applied to extra mortgage payments. Now, the investment income that you generate, such as the interest, dividends, rental income, or business income, can also be directed toward reducing the non-deductible mortgage balance. And then the most important part, most mortgages allow prepayment options, enabling you to pay off the non-deductible portion faster. Now, the cycle continues. As your non-deductible mortgage decreases, your available HELOC credit increases, providing more funds to invest, and the cycle enhances your tax-deductible interest and accelerates wealth building. Now, why does the Smith maneuver even matter? Well, the hidden cost of mortgage interest, most people are not aware. A lot of homeowners out there only focus on their monthly mortgage payment, but haven't you ever thought about how much you actually need to earn before tax just to cover the interest on your mortgage? Let's look at an example. If you have an $800,000 mortgage at 3% interest with a 25-year term, you will pay approximately $338,000 in total interest over the life term of the loan. Now, here's the real problem. That $338,000 comes from your after-tax income, meaning that you actually need to earn a lot more before tax just to cover it. If you make $90,000 annually per year, say you make $90,000, your marginal tax rate is about 30% in Ontario. So you need to earn about $483,000 in pre-tax income just to pay that $338,000 of non-deductible mortgage. If you are someone that makes a little bit more, say you make $150,000 salary per year, your marginal tax rate is 45% in Ontario, so you would need to earn $615,000 before tax to cover the same interest expense. Now let me ask you, what if you could convert that non-deductible mortgage interest into a tax-deductible expense? That's exactly what Smith maneuver does. Instead of needing $483,000 of gross income at a 30% tax rate, you now only need to generate $338,000, a difference of $145,000 over a 25-year period. If you make $150,000 salary, instead of earning $614,000 pre-tax dollar just to cover the mortgage interest, you would only need to make, guess what, $338,000 to cover the interest expense, freeing up $276,000 of pre-tax income that can now go toward investments, savings, paying off your home faster, instead of just paying the bank. This is why the Smith maneuver is such a powerful tool for homeowners looking to maximize their tax deduction and improve their tax efficiency while building wealth. Now, why is now a good time to consider the Smith maneuver? Well, recent changes in interest rate have created the perfect conditions for implementing the Smith maneuver. Number one, the cheap fixed rate mortgages are ending. Many homeowners secure low fixed mortgages, like the case in my sister-in-law, 2.19% for 5 years, and it's expiring. And these fixed rate terms are expiring, and the current 5-year fixed rates can be as low as 3.89%. Now, the opportunity to hold on to these ultra low rates is coming to an end and making the tax efficient strategies like the Smith maneuver more attractive. For them to work perfectly, you want the HELOC interest rate to drop. And now HELOC interest rates are dropping. HELOC interest rates are tied to the prime rate, which is coming down. Last week, we had a rate drop, and we're expecting more in the coming year. Now, as of now, Scotiabank's prime rate is 4.95%, and more rate cuts are expected this year. Now, lower HELOC interest rate means that it's cheaper borrowing costs for investing. And if the delta between the HELOC interest rate and your primary residence non-deductible mortgage are smaller, it's the perfect condition, perfect recipe for the success of Smith maneuver. Now, number three, the mortgage and HELOC rate gap is shrinking, which I mentioned earlier. The Smith maneuver works best when your mortgage rate is similar to or higher than your HELOC rate. With HELOC rates dropping and fixed mortgage rates rising, the gap is closing and making now a great time to revisit this strategy. It wouldn't have worked before because the gap between the low fixed rate, 2.19%, and like 6-7% of prime rate, HELOC prime rate interest is such a big difference that it would not make sense to convert your low interest rate primary residence mortgage into something that's way higher, that costs you way more. The saving is not going to work. Now, is the Smith maneuver right for you? Well, consider the Smith maneuver if, number one, your mortgage is up for renewal and now you're facing higher interest rates. Number two, you have or can obtain a readvanceable mortgage. That's a prerequisite. Number three, you're comfortable investing in income-generating assets. If you're one of those people that are not doing it, you're not comfortable with it, well, this is not for you. Number four, you have a stable income to manage the HELOC income. It's important to understand that this strategy initially will create more cash outflow. So you need to have the ability to pay down the HELOC interest payments. Number 5, you're disciplined enough to track your finances properly for CRA compliance. As we all know, in Canada, if you want to earn a deduction, you do need to put in the work to earn it, meaning that you need to keep track of all your documentation, payments, tracking, bank transfer, or everything come together. Now, you may not want to implement this. This may not be the right fit for you if, number 1, you're locked into a low fixed rate mortgage with years left on your terms. There's no immediate tax benefit. Sometimes you even lose money. Now, number 2, if you are not comfortable with investment risk or managing debt, so don't implement Smith maneuver. Number 3, your cash flow is already tight. If your cash flow is already tight and you have no extra cash flow to cover the HELOC interest, it might not be something that you want to consider. Now, number 4, you aren't willing to keep good financial records for tax purposes. With that, let's go through a real-life example on how this Smith maneuver strategy would be able to help this particular real estate investor to cut down their primary residence mortgage repayment term by 14 years. Now, let's walk through an example together. Now, let's go through the example together. On the left-hand side, we're having some background information, talking about the background information about this example. First, let's say your home value is now at $1.5 million, and the amount of mortgage outstanding is still around $800,000. Now, HELOC right now is only available up to 65% loan to value. So you have to be careful with this point, because if you are borrowing and against your HELOC, you may not be able to have a readvanceable mortgage all the way up until 80%, up to 80% of the 1.5, 80% of the 1.5. It's equivalent to 1.2. In the old days, you would be able to access up to $1.2 million, assuming the bank approves it and you have the income to justify it, up to $1.2 million of your home value. But right now, the bank changed the rule recently, and what they are allowing is up to only 65% loan to value. So we're talking about 65% of 1.5 million. So 65% times 1.5 million is a total of $975,000. Out of the $975,000, $800,000 of the debt has already been borrowed, so you would not be able to access that $800,000. It would be in the form of mortgage, and the HELOC that's available is whatever that's left over. So if you are approved up to 65%, your loan to value would be $975,000 in our example. $800,000 has been used as a mortgage in the form of a mortgage, and the rest would be remaining in the home equity line of credit format that you would be able to eligible to draw it down and use it to pay for your investment property expenses. Now, in this particular example, this taxpayer would have about $175,000 HELOC room available for him to draw out to invest or reinvest into his property altogether. Currently, HELOC interest rate, according to Scotiabank, is about 4.95%. This number can go down, and it's expected to go down, which is awesome because this will give you bigger benefit if you are able to lower the interest rate. Now, I do believe that the posted fixed interest rate could be as low as 3.89% or something along those lines at the moment when we record the video. So I'm just picking 4% as the mortgage interest rate. Now, the mortgage interest, let's say you're renewing and you're offered 4% and you agree to it and you decided to extend it, the amortization period to 25 years, you renew everything. So 4%, 25 years, and right now we are in 2025. Now, let's say the same taxpayer also has an investment property, and this investment property generates $3,300 of rental income on a monthly basis, and we're talking about gross rental income. So this payer ultimately, after renewing the mortgage at 4%, with the mortgage amortization period of 25 years, and with the mortgage outstanding at $800, monthly mortgage repayment amount would be $4,208. So this is about every month what they have to pay into their mortgage. This taxpayer also has an investment property, and that generates a gross rental income of $3,300 on a monthly basis. So, and this is the key. You need to be able to generate the investment return in order for you to apply this Smith maneuver strategy, because we're trying to convert a portion of the debt from your home into something that is income generating for investment purpose. So you need to have some sort of an investment in order for Smith maneuver strategy to work. Now, Smith maneuver strategy would also work if you're not generating rental income, you're generating interest income, dividend income. In my example here, I'm using a rental property monthly rental income for diversion. Now, this particular taxpayer also has marginal tax rate of about 30%. Now, I'm just picking 30%. If you're making more than $90,000 roughly in Ontario, your marginal tax rate is going to be higher than 30%, and meaning that your saving would even be higher. Now, let's look at what type of savings you would have available. Okay, so now let's look at the impact of Smith maneuver. Now, before doing Smith maneuver, this person would owe $100,000. We talked about it, and 4% interest rate with amortization period of 25 years. So the monthly repayment amount is $4,200. Now, over the life term of this 25-year loan, we are looking at paying $463,000 of interest cost. $463,000 of interest cost total for the full term. Now, if you borrow $800,000, you need to pay $463,000 of interest based on 4% interest rate. That is huge. How much money do you really need to make before you would be able to afford that $462,000 of interest expense? It is a lot. Now, this is the reason why when you apply the Smith maneuver strategy, you're able to redivert and convert some of that debt into tax-deductible debt. Now, what we do is for someone who's earning $3,300 of monthly income, the rental income would be applied and used to pay off the mortgage earlier, because your mortgage often comes with prepayment privilege available. So instead of paying the $3,000, you collect the rental income from your tenant, $3,300, and then you apply that $3,300 directly into your monthly mortgage. So you make a monthly prepayment into your home equity primary residence mortgage. So you do that every single month, and all of a sudden, your interest rate has come down. By applying that $3,300 monthly prepayment to your home, to your non-deductible primary residence mortgage, you're now looking at only $187,000 of mortgage interest, and you will be repaying your mortgage 14 years earlier. 14 years. Instead of waiting until 2050, because now it's 2025, a 25-year term mortgage is going to bring you to 2050. Now, by rediverting that $3,300 monthly rental income, you're going to pay down your mortgage completely by 2036. So by doing the rediverting of that rental income, you're now paying off your mortgage 14 years earlier. Now, just because you pay down the mortgage does not mean that you don't have the debt. The debt, it would still be there. It's a different type of debt now. When you pay down the mortgage, you can now refocus on paying down the HELOC balance that's being used for investment purpose. And that HELOC balance can also be complete. You can finish repaying your HELOC balance by 2045. Using the same mortgage payment amount, you would be able to redivert it and pay down everything by 2045. So this is a pretty cool strategy if you apply it right. Now, the amount of after-tax dollars that you would save by applying the Smith maneuver is about $126,000. And the gross income that you would need to generate $126,000, it's about $180,000. So this is a substantial amount. Now, Smith maneuver strategy require careful tracking, step-by-step opening new accounts, designated new accounts for rent collection, and use the rent that you receive to pay down the mortgage like I mentioned earlier. And then you need to draw out from your HELOC mortgage and then send it back to the rental expense account and use that rental expense account just to pay all your rental expenses, including property tax, insurance, mortgage mortgage payment, everything from that rental expense account. Now, this type of strategy requires a lot of dedication, and commitment as well, but it is worth it. Now, if we look at and dissect the benefit of this strategy in this particular example, you can see that in year one, if you don't apply Smith maneuver, you will, just like what I discussed before, if you don't apply Smith maneuver, you'll incur about $31,000 of interest cost, non-deductible. However, if you apply Smith maneuver, you make $3,300 monthly rental income. You redivert the $3,300 religiously from your own rental expense account into your primary residence mortgage using the prepayment privilege that you have. You would be incurring only $30,000 interest expense. Now, this non-deductible interest expense is still there in year one, $30,000. You essentially save about $728 because that's non-deductible interest that you are able to save. Now, you just compare these two numbers and you get $728. Now, but you are also at the same time borrowing from your home equity line of credit to pay for your rental expenses. So when you borrow from your home equity line of credit, you also incur interest expense. So that interest expense works out to be $1,062. So you can see that the non-deductible interest saving is $728, but you need to incur $1,062 on your home equity line of credit to pay for the rental expenses. You may first think it may not be worth it, but we also need to look at the tax saving. Now, in our example, our tax saving, we're looking at it's about 30%. So your marginal tax rate is 30%. So you're able to essentially have the tax deduction right off this HELOC interest of $1,062. You would then be able to deduct it on your tax return. And hopefully you would have a tax refund, and that tax refund is approximately $319. So after taking into account the tax savings, you take your HELOC interest expense, but you have some tax saving, your net after-tax saving is about $743. Now, if you compare that after-tax HELOC interest cost compared to the non-deductible interest savings from rediverting it, you are now left with a negative $15 in year one. Now, this sucks because you're actually not making money in the first year after 4 years of working. But then if you continue the process, if you look at year two, by year two, you are saving $2,357 of non-deductible interest saving. Now, because you have been drawing out from your home equity line of credit to pay down the expenses of your property, now you're incurring $3,022 of HELOC interest for the full year. And that would give you a tax saving of about $907. So when you combine the tax saving and the extra HELOC interest cost, you are now, your after-tax HELOC interest expense would be $2,115. But by doing that, if you compare the $2,115 after-tax HELOC interest cost with the non-deductible interest saving that you have, the delta of these two numbers, $2,357 and $2,115, is about $242. So you're seeing result in year two. You're saving about $242. Now, and then year three goes on and you're saving $565. Year four, you save $956. And you keep going and going and going and going. So ultimately, you would be able to save as much as $439,000, almost $440,000 in total by the end of 25-year term. You are also paying down your mortgage paying off your entire primary residence mortgage by the end of 11th year. So by the middle of 11th year, and that gives you saving, that allows you to pay off your primary residence mortgage for 14 years earlier. Now, by implementing this strategy, you are converting your non-deductible interest into something that's tax deductible, freeing up cash flow, and accelerate your path to financial freedom. But there is a downside to this strategy. It's not for everyone. The reason why it's not for everyone is because it helps you, yes, it helps you save interest costs and pay down your primary residence mortgage faster. But the problem is that in the short term, you still need to be prepared for this additional cash outflow. And let me explain what this cash outflow is. The cash outflow is your HELOC interest. When you first commit to renewing your mortgage of $800,000 at 4% interest rate with a 25-year mortgage amortization period, you basically log into this thing that's called a fixed monthly mortgage payment. And in this example, it's about $4,200. So every month, you still have that obligation to pay that $4,200 of monthly mortgage payment. But at the same time, when you do the rediversion of your rental income to pay down your mortgage faster, your monthly mortgage amount is fixed, but you're also drawing out from your HELOC, your home equity line of credit. You're borrowing money from the bank. When you borrow money from the bank, you need to pay interest. And that interest cost is an additional cost on top of your monthly mortgage payment. And in year one, we're talking about $1,062. And in year two, it's $3,022. Year three is $4,982. And so on and so forth. Now, these numbers, although you would be able to have tax saving as a result from claiming them as an expense, but there is still an immediate expense cash outflow that you have to come up with in the initial years. So I want you to be aware of this initial cash outflow. Now, over time, you can convert the HELOC outstanding into something that's a mortgage payable. You can do different things, or you can re-extend your primary residence mortgage to a longer amortization period, which allow you to lower your monthly expenses on your committed mortgage repayment and reduce some of the cash outflow commitment. But as a minimum, at the very beginning, the options to reduce your monthly outflow would be limited, and therefore it is important to understand your particular situation. Are you able to meet that HELOC interest outflow, at least on the immediate term? Well, it's now the time to start the Smith maneuver and cut down your primary residence mortgage repayment terms by 14 years. Well, with mortgage rates rising, HELOC rates dropping, and more rate cuts expected, now is one of the best times in years to reconsider this strategy. Would you rather pay the bank hundreds of thousands in after-tax interest or redirected the money toward wealth-building investment? Thinking about trying the Smith maneuver? Let me know in the comments. And if you like our video, make sure you give us a thumbs up and share this video with people who are also interested in building wealth. Until next time.